I assume we're off and running, and I'm going to get going here. My name is Steve Lentz. I am with OptionVue Systems, and our, it says I'm very loud. Okay, I'll up a little bit. Move the mic a little bit away from my mouth. Is that good? Much better, hopefully. My name is Steve Lentz. I'm with OptionVue Systems. It's the same. Oh, I'll try this. Let me bring it down. How about there? Is that a little better? Okay, I moved the thing down. Hopefully that's a little bit better. Excellent. Okay. Now it says I'm too soft. All right, let's bring this up just a squeege. There we go. Hopefully that'll be good for everyone. All right. Split the difference. There we go. I'm Steve Lentz. I'm with Discover Options. We are the educational arm of OptionVue Systems International, which has been in business since 1983, primarily involved in the high-end option analytics software sphere. And we rolled out Discover Options as our educational arm about 10 years ago or so. I've been with the company since 1998. And here a few years ago, we rolled out an advisory called the VXX Trading System. And that's why I'm here today, is to tell you guys about our VXX Trading System. I'm going to show you everything about it, the philosophy behind it, the indicators we use, the whole shooting match. So buckle up here. I think you're going to really enjoy this. Take a look at this equity curve. Now, we rolled out the systems we're using now. We rolled these out on March 6, 2016. We went live with this then. And since then, we've had a return of 219% with an annualized return of 174%. And when I show you the philosophy behind it, it's going to make a lot of sense. It's not a simple technical analysis pattern or anything like that. We're talking here about derivatives, volatility derivatives, and there's an angle here that you're going to have to really focus in on to understand and really see really why there's an opportunity within the assets that are trading in the markets right now. But we've had a lot of success. 219% return. The max drawdown was 24.6 since that time. So it's called the VXX Trading System. So with those returns in mind, let me show you exactly what the system does. It was developed by Len Yates, the founder and president of OptionVue. And it involves timing of the entry and exit for your capital to go in one of three different places. First, you could be long the VXX. Okay, that's an exchange-traded product, the iPath S&P 500 VIX short-term futures exchange-traded note, or your capital would be long the XIV, which is the Velocity Shares Daily Inverse VIX short-term exchange-traded note, or your capital would be in cash. Okay, now the VXX and the XIV, it's important to know that those are exchange-traded products, much like stock. So they're appropriate for IRAs, 401ks, etc. You just buy shares. Now, each of those relates greatly to the VIX. Okay, and so I want to touch on the VIX a little bit before we get going here. So here's a bar chart of the SPX, and under it you have a blue line and a red line. The red line, never mind that, that's statistical volatility of the index itself. What I'd like you to do, please, is focus on the blue line, which is the volatility implied by the time premium in the options on the SPX. Okay, it's called implied volatility. It's another way of the VIX is measuring that. It's a 30-day number, which is what this blue line is here. And what I want you to notice is typically as the market goes down, look at times when the market goes down, notice how that blue line goes up. Now, why is that happening there? And it's pretty much a constant pattern. You'll see when the market goes down, the blue line goes up. And likewise, when the market goes up, the blue line comes down. Now, what's going on there is that as the market comes down rapidly, the portfolio managers out there managing billions of dollars in long equities, they will rush to the SPX put option market and begin buying put options to help hedge their long holdings. If they're long billions and billions, it's not easy for them to get out and come back in. So they use derivatives like options and to hedge their long holdings. And as they rush in the market to buy puts, that drives the price of the options upward, and that's reflected then in the blue line rising. The volatility implied by the cash options begins to rise. Okay, so with that inverse relationship, keep in mind too, one other point here is the Chicago Board Options Exchange has, you know, they have a corner on the market on the SPX. Okay, that's where it's traded, the CBOE, the CBOE. Now, they also rolled out the VIX measurement, the measurement of implied volatility of the SPX options. Now watch this though. As time went on, this became a very popular instrument of measurement. And what the CBOE did here is they rolled out a futures market on the VIX. Much like you have a futures market on wheat or coffee, they rolled out a futures market on the VIX number itself. Now, and then what happened is that the hedgers of the world, the portfolio managers that needed efficient ways to hedge their long holdings, they began to not only use put options, but also use the VIX futures. Today now, there's a very liquid market in the VIX futures. It's pretty awesome. So with that in mind, that the fact that is a futures market on the VIX, let's go then and take a look at the system that we're talking about here, the VXX trading system. Long the VXX or long the XIV, or you're in cash. If you're long the VXX, your money is then in a fund, so to speak, that is managing a long VIX futures position. If you buy shares of the VXX, your money is being used in a long VIX futures position. If instead your money is in the XIV, your money is in a fund, so to speak, and there's a manager managing a short VIX futures position. All right. Now, mind you, your money is not being used by you to trade futures. You are not personally trading futures. Your money is in the exchange traded product, and they are trading the futures. Okay, so you just buy shares. You don't trade futures at all. You just buy shares, and your money is being used that way. Okay, just want to make that part clear because that part's very important. Now, before we get going, I want to just full disclosure, we do have an advisory service. We email you trade alerts on everything I'm going to show you today, the signals. We give you the proprietary indicators and more of what I'm going to show you here today. And those are available in both the member section of our website and also within our OptionVue 8 software if you're a subscriber. Finally, we also have monthly status emails available to you as well. So just wanted to fully disclose that. And also, before we get into the system, you should know that the VXX and the XIV are both very liquid assets. The VXX averages over 80 million shares a day, the XIV over 30 million shares a day. So if you get a signal to trade, to take a position, to get in or out, know that you are dealing with some pretty liquid assets here. Here is the heartbeat of what makes the VXX trading system go, and that is the Yates VXX Indicator. The Yates VXX Indicator, we call it YVI for short. This is a 15-day moving average of a component. I'm going to have to take some time to explain here. All right, and so, but what you'll see then is that it oscillates up and down, and there's there's a green line and a red line. Those are certain thresholds. And so as the indicator ascends above a certain threshold there, that signals that the system go long the XIV. Okay? Now, in this case, we were long the XIV for about 3.5 months. When it descended below a certain threshold, that was the signal to get into cash. This is starting back when we went live with these signals here, just last year, in 2016. It ascended above the threshold. It went long the XIV for about 3.5 months. It then exited into cash for about 2 weeks or so. Then it went back long the XIV before exiting into cash roughly, about 3.5, 4 months later. So let's take these signals that are flashing across the board here along the YVI indicator. Let's go to the XIV price chart so you can see what happened with these signals, okay? Let's just transpose those signals onto the price chart. Watch what happened here. Back on March 7th of 2016, when this thing fired a signal at 2118, it was long the XIV for about 3.5 months, and then it exited at, this is pretty small on my screen. I want to see everything, so I'm not going to magnify. Basically over, yeah, I would say, what is that, 34? Something on my little handout. It's second here. Should have notes for myself. There we go. Yeah, 30.05, something like that. Basically a gain of, say, about 40%, something like that. And then it went long the XIV at 26.52, exiting at 35.82. That was a gain of about, 33%. And then in November, on November 16th, it went long at 40.45 and exited then in March at 67 and change for a gain of well over 50%. And so when you have gains of 30% here, 45% there, and then 50%, and if you were to reinvest fully, every time you go into cash and you come back in the market, you invest at the full number of shares that you can. If you're fully invested the whole way, and you had done this since, say, 2009, when we started back testing this, our back test takes it back to that far. $10,000 today, fully invested with every signal, would today be worth over $3 million. Okay, $3 million. And that's the power of compounding returns when you're taking off chunks at 30% here, 45% there, 50% there. You're going to have some outstanding compounded returns. Now note, you'll see if you look carefully, there are periods where the system is definitely simply in cash, and that's where you see the little plateaued regions in the equity curve here, okay? And that's because the system was in cash, and it can go a period of weeks in being in cash because just the market conditions are not right. So what makes this system really hum? What is behind this thing driving this? And the answer to that is something we call the daily roll. The daily roll. Now, to explain the daily roll, I have to show you a screenshot of the VIX futures prices. The VIX futures prices, and that's what you're seeing here. And this is a screenshot from the quotes display back in mid-January. And I like showing it this way because you got January through Sep, a clear, easy progression. And what I want you to notice is that we were in a bull market at that time. Notice that the January VIX futures price is at 1220. On down at September, it's at 1925. And before I go further, let me ask you, is the market more volatile in a bull market or a bear market? You don't have to type it in, just answer to yourself. Is the market more volatile when it's bullish or when it's bearish? And I think if you've been in the markets for very many years at all, you've lived through a bear market at all, you will then know that a bear market is far more volatile than a bull market, because if you're in the middle of a bear market, we know that the trading ranges can be crazy. All right, and everyone's on pins and needles. You can have gaps that are very, very far from the previous close. And everyone's on pins and needles, And it's much more volatile in a bear market. In a bull market, when the market's chugging upwards, some of those daily ranges can be tiny compared to a bear market, just minuscule. And so what you're seeing here is something very reasonable, that if we're in a bull market, we know that in the next month or two, we'll probably stay in a bull market. Volatility will be relatively low. But you know what? Out in the distant future, 9 months from now, we know that a bear market can come upon us. And if it does, the volatility will be much higher out in that distant future. And the more distant in the future we go, the more likelihood that we're going to have a bear market eventually. And so that's why you see this progression. We call this an upward price structure. An upward price structure, low to high. See that? Now think about it. If we were in the middle of a bear market, these numbers could easily be inverted. Okay, I'm working our way to the daily roll. Okay, it's important that we understand price structure of the VIX futures, though, to get this. Okay, think about it. In a bear market, what would these prices look like? They would be inverted, where the front month top, January, could be at 1925, and down at the bottom, SEP could be at 1220. Because in a bear market, we know that in the next few weeks or months, we're all on pins and needles. But you know what? Out 9 months from now, we all kind of know eventually the market is going to turn around and begin its upward ascent once again. And when it does, volatility will drop, and we'll be back to chugging our way upward in a much lower volatility environment than what we have in our bear market. So that would be called a downward price structure. In a bear market, it's downward. In a bull market, it's upward, low to high. Now, with that in mind, I want to take us to Larry McMillan, because he rolled out this idea way back in 2012. And I really want to give credit where credit is due, because he did a great job in his Option Strategist newsletter of kicking off this idea. Len Yates read about this. We passed it around in the office, and Len just took off and made some great indicators to tee off on this idea. So let's take Larry's word-for-word explanation and walk through this slowly. Here we go. Both the VXX and the XIV are constructed in such a way that they actually own, as in the case of the VXX, or are short, as in the case of the XIV, the two VIX nearest month futures. Very important. Now, each day, part of the position is rolled forward so that a constant 30-day forward position is simulated. Okay? Now, when the term structure slopes upward, like what I just showed you, okay, which it does most of the time, like a bull market, that daily roll is a debit and is a drag on the performance of the VXX. I'm going to show you an example in just a second. However, since XIV is the opposite, it is a boon to the XIV. Again, I'll show you an example in just a second. Conversely, when the term structure of the VIX slopes downward, okay, like a bear market, that daily roll forward for the VXX is a credit, allowing it to outperform the VIX, and consequently is a detriment to the XIV. Let's go and look at an example here. Focus your eyes, please, on the left side. On the left side, you'll see VXX. Remember, if you own shares of the VXX, we are long the front 2 months, Jan and Feb. Our money is being used to manage a long VIX futures position. Now, every day, we have to peel off a little of Jan and roll it to Feb, because we're maintaining that 30-day forward position. We peel off Jan, roll it to Feb. Because we're long, that means we have to sell Jan and buy a little bit of Feb. Now look at the prices over there. If we're selling Jan at 12.20 and buying Feb at 14.20, that is a net debit. We're selling low and buying high. That debit can have an immediate and real impact on the price of the VXX. And in our service, we actually document that in a big way. Now, Instead, let's go over to the right side of the screen, XIV. Remember, if you're long the XIV, your money is being used to manage a short position in the VIX futures. The front 2 months, you're short the front 2 months, the daily roll forward to manage that, to maintain that 30-day forward position. We have to scale out of Jan and go a little bit more into Feb. Peel off Jan, add to Feb. Meaning we have to, because we're short now, we have to buy a little bit of Jan, sell a little bit more of Feb. And if we buy at 12.20, we're buying lows, selling high at 14.20. That is a net credit, and that will then help the price of the XIV. See that? So with that in mind, that is the daily roll effect we're talking about. With that in mind, let's go back to McMillan as he tees off on this. So the idea behind the trading system is simple enough. When the VIX futures slopes upward steeply enough, that is a roaring bull market, and we want to own the XIV. We want to be short the VIX because that daily roll is beneficial and because VIX is expected to decline. Now, on the other hand, when the slope is downward, like in a bear market, we want to do the opposite, own the VXX. Because the market is bearish, the VIX is increasing, and the daily roll is beneficial to the VXX. Okay, so it's kind of like, you know, we're just, it's like we're in a sailboat, okay, and we're waiting for that daily roll to get real fat in one direction or the other. And when it gets really fat in one direction, let's say it's really helpful to the XIV, we're then going to put up the sail and go with the trend and go with the XIV. All right, so a little sailboat here. Now, when that daily roll winds down and crumbles back to nothing, we're going to take the sail in. We're going to go into cash and just wait. We're going to wait to see which way the daily roll blows. And if it blows in the direction of the VXX and is benefiting the VXX, well, then we're going to go long the VXX at that point. Okay? But either way, we're just going with the flow of the strong daily roll. And every good sailor has good navigational tools, and we have that at OptionVue and in the VXX trading system. Let me show you the main tool we use to help navigate these waters. It's what we call the VIX diff. The VIX diff. And this is the difference in the prices of the front 2 VIX futures months. Okay? This is the main measurement we use to apply some tools to get the timing of this correct. So what we do is we take the second month minus the first month to come up with a VIX diff value. Now, if you'll look at here, it's 1420 minus 1220 is equal to 2. Okay? If it was inverted, we could have Jan higher than Feb, and it could be a negative number, but we cannot show a negative number in the last column. So what we do is we take that actual number. In an option view, we'll stick it in the change column, and then we'll add it to a base 0 of 10. Okay, so if it's a positive number, we'll have something above 10, perhaps like 12, like you see here. If it's a downward price structure, then we'll be under 10, say something in the 8s and 9s. Okay, and so with that said, let me see here. Let me show you how we have at OptionVue. We have gone back in time and have collected data for the VIX diff, and going all the way back to when this started, we have collected the open, high, low, and close of the VIX diff going all the way back. And we've actually, you could create bar charts, and in OptionVue anyway, you can actually see the bar chart of the VIX diff. So what we do now is we apply a 15-day moving average to this. This is how we started, is with a simple 15-day moving average. And for a while, that was our core signal. But you know what we found out is that by adjusting this moving average for volatility, it really helped refine our signals. And that's what we came up with. Look at the YVI down below, our indicator, is very similar looking to the 15-day moving average that you see up above. And after adjusting for volatility, okay, we end up with the Yates VX Indicator, the YVI, which is a 15-day moving average of the VIX diff proprietarily adjusted for volatility. Okay? And what we do then is we take that indicator and we apply some thresholds to it. When it crosses above 0.83, the system goes long the XIV, and it's long the XIV until it crosses back down below positive 0.83. Okay? Now, if it does descend beyond -6 or -0.6, that's the downside threshold. If it goes down below that, the system then goes long the VXX instead, and it will stay long the VXX until the YVI comes back above -0.6. And so there's three regions here that you can see. The area in between the red and the green dashed line, that's where we're in cash. If we're above that green dotted line or dashed line, we're long the XIV. If we're down below the red dashed line, it's long the VXX. Now here we have an example where the system was long the VXX back in August of 2011. So let's just go over to a price chart and take a look at that. You can see here, it went long the VXX August 5th of 11 at 15.15.5, and then it exited into cash back over in November at 23.44. So that was a gain of 50% just right there. Just an outstanding signal. Outstanding signal. And so the bottom line is that we really want to be in a position to take advantage of that strong daily roll. And this is my last point that I want to make here. It's this is the last point, is that we want to be in a position to take advantage of that strong daily roll. And the question here is how significant is that daily roll? Let me just show you. This is a screenshot, again, from mid-January. And part of the service we provide is understanding the daily roll effect. So here's an example. It's called the XIV daily roll effect, available at the, as an indicator on our website or in the software. But in this particular date, with the XIV at 55.23, that 1 day's daily roll effect was 36 cents. Okay, 36 cents. Now, how much is 36 cents relative to 55.23? Okay, it works out to be more than 0.5% for just that 1 day. Now you take, that's a calendar day. You take times 30 days at that pace, you're at 19.5% for the month. For the month. Now, how much is 36 cents? But that is by no means the highest it's ever been. It's actually in the lower portion of the upper area. Okay, this is the kind of daily roll effect we're aiming for when we do this. We want to always be in a position to take advantage of this kind of a strong daily roll. And you know what? If you're in the VXX XIV only when your daily roll is benefiting you, well, this is how you can imagine that we could get these kinds of returns compounded. There's going to be drawdowns, clearly. There's going to be periods of plateaued flatness like that when the market conditions aren't giving us a daily roll, and we're not going to be in the market if it's not giving us a daily roll. But if we're only in one of these ETNs when there's a strong daily roll, the odds are then in our favor, and we can accomplish great things. So where do you go from here? All right, because that's a great introduction to exactly what we're all about. So we do have a few more things for you to consider getting into, and that is we have 2 more videos for you to watch if this interests you. You could go to vxxtradingsystem.com. Okay, sign up, log in, and we'll give you the information to watch 2 more videos done by Len Yates. He used animation software to explain why portfolio managers have to use these markets. And as long as there's market volatility, you're going to have this opportunity available to us. And as long as these instruments are trading the way they are, that opportunity is just very present. We also have an ebook. If you like to read printed material and digest the information that way, we have that available as well. Okay, now after you educate yourself, you could go to our website, VIX Trading System, and subscribe. It's $1,200 for the year. And with that, you get, as I said before, trading alerts and signals. So if there's something flashing for you to enter or exit, we'll get you that signal well before the end of the trading day. I've gone and looked at all the signals I've received, and it is easily at least a couple hours before the close. All right. Also, all of the indicators I showed you and more are available within the OptionVue software. If you're a subscriber, we also have a member section of our website, as well as monthly status emails. So Chris, if you'll notice, the system can be long, the XIV or VXX, for a period of weeks, if not months. And so you'll only get a trading alert on the day that an alert is firing. Otherwise, we give you monthly status emails as well. But whenever we have a day where an alert is fired, you'll be alerted to it. Okay, so this is clearly not a swing trading system. You're not getting 2-3 signals a week. Okay, as I showed you before, each trade has been in the market for weeks, sometimes going on months there. Okay, but you do get, there's steady communication. There's also a forum that you could use with other VXX trading system users. Also, as on one of the charts, you may have seen a little purple indicator. That's a discretionary danger indicator. Some of our users like to use that in a more discretionary way on some of their other trading as well. The forum is a great place for folks to exchange ideas on how to use some of the additional information. Monthly status emails as well go out to all of our subscribers. Let me show you a little screenshot of our quotes display, and this is available live in the software, live on the member section of our website. You'll have the VIX futures prices. You'll have all the indicators I showed you and more, including the danger indicator, the daily roll effect, etc. Okay? If you have any questions about this, you could always call us at 847-816-6610. We have some reps that can speak to you about anything pertaining to this system. I know Jim has been in the room here answering a lot of questions for folks. Are there any re-entry points? Well, if the system fires a signal to get into cash, okay, let's say you're long the XIV and it tells you to get into cash, and maybe you're in cash for a few days, if not a week or two, well, then it might go back into the XIV, okay, and then you would get an alert saying, hey, the YVI crossed the threshold, the signal's now firing to get back in the XIV. You would be alerted to that. All right, I don't know if Jim wants to add any more to that, but that's kind of how the system works. It's just systematic with our indicator there. It's done very well. But those other two videos will give you some information on the danger indicator, a little more background if you wanted to venture out on your own and do some more discretionary trading using the tools and the information that it gives you. Yes, Chris, you would be able to, in an option, if you're an OptionVue subscriber, you could bring up the price charts of the VIX diff and see that, and then also see the YVI crossovers. Absolutely. Now that's if you're an OptionVue subscriber. On the member section of our website, you're only getting the screenshot I'm showing you here in terms of the current status of those indicators as they occur today, and also in real time. But the historical price chart data is available to the OptionVue subscribers. Okay. And you can also go to OptionVue.com and get a free trial. If you're not a subscriber, give OptionVue a try. There's no trial of the advisory, though, but certainly of the software itself, there are free trials. Yeah, the indicators, Chris, work only in OptionVue. The VIX diff is something compiled by OptionVue exclusively for OptionVue subscribers. Um, oh, you can see the quotes and the charts on the. Oh, okay, they added charts. Oh, that's awesome. It's fairly new to have the charts, historical charts, in the website. That's great. It's great. Dana, no, I don't think we were there. We're not at the money show recently. We've gone in years past. We haven't gone recently. Everything's gone online so much. Do a lot of our marketing online just like this. Okay. See any other questions? I really appreciate the folks at Cyber Trading University for having me aboard here to present this. I love talking about this stuff. It's just, yeah, we might be in Vegas coming up in November. That'd be great. Yeah. Yeah. Eric, thanks so much. And thank you to Cyber Trading University for having me. I've really enjoyed this. And they have a great platform and a great service they provide. Thanks so much, everyone. Oh, do you buy the options? Oh, great question, Chris. Do you buy the options on the VXX Indicator? So we do not. Our advisory only has us in the VXX or the XIV. Now, some folks like to try and do spreads in the VXX options. We have found that the best returns have been trading simply the underlying VXX and the XIV. I've tried coming up with credit spread approaches in the VXX using some of the signals, and in terms of return levels on capital, it hasn't worked out as well as just trading the underlying, to be honest. Just trading the underlying has worked better. But doesn't mean to say you couldn't subscribe to OptionVue and the service, take it, and then get our back trader program, and then start back testing, working out a system. I gave some time to it a few years ago, but since things have penciled out so far to be so outstanding, we just stick with this. Okay. Eric, thanks so much. I've really appreciated it.